Did you know one of the biggest tech companies on Earth just lost 91% of its free cash flow in 3 months, and almost nobody is talking about it? That's not Tesla, that's not Apple, that's Meta. And that's just the first of 5 stories the market moved on this week that you probably haven't heard about yet. Stories that could shape your portfolio far more than another headline about interest rates. Quick thing before we dive in, hit subscribe because we post multiple videos a week covering the biggest global financial market news straight to the point, so you never have to go digging for it yourself. Let's start with Meta. Shares dropped around 8% after the company issued a weak revenue forecast for the coming quarters, but the number that really spooked investors wasn't the forecast itself. It was free cash flow, which collapsed 91% in the second quarter. Think about that for a second. Free cash flow is the money a company actually has left over after paying for everything it needs to run and grow the business. It's the number serious investors watch closest because it tells you whether a company's profits on paper are turning into real usable cash. And Meta, a company that has historically been one of the biggest cash generators in all of tech, just saw almost all of that cash disappear in a single quarter. That means Meta is burning through money at a brutal pace on heavy investment, mostly infrastructure and AI build-out, data centers, chips, and talent, without delivering the returns the market wanted to see right now. The contrast is stark next to Microsoft, which surged the same week on strong cloud results, proving that spending big on AI doesn't automatically spook investors. What matters is whether that spending is actually translating into growth investors can see and measure. It's basically 2 AI investment strategies going head-to-head in real time, live in front of everyone. One company spending and delivering, the other spending and still trying to convince the market it's worth the wait. If you're holding tech stocks or thinking about adding some to your portfolio, this is exactly the kind of signal worth watching closely over the next couple of quarters, because it tells you which companies the market is willing to be patient with and which ones are running out of runway to prove themselves. Second story, a multi-billion-dollar merger that flew almost completely under the radar with all the AI noise dominating headlines this week. Intercontinental Exchange, the parent company of the New York Stock Exchange, agreed to buy MarketAxess, one of the biggest electronic trading platforms for fixed incomes and bond markets in the U.S. The price tag? $167 a share in cash, representing a 33% premium over the stock's closing price, which values the whole company at roughly $5.7 billion. Now, bonds might sound boring compared to AI stocks and crypto, but here's why this actually matters, even if you don't hold either stock in your portfolio. Deals like this show that the biggest players on Wall Street are betting heavily on consolidating control over the infrastructure that runs the debt market, the pipes and plumbing behind trillions of dollars in bond trading every single year. That's usually a strong signal that large institutions expect more volume, more volatility, and more money flowing through that market in the years ahead. Exchanges don't spend billions of dollars buying trading platforms because they think business is about to slow down. They do it because they see a wave coming and want to own the toll booth. It's worth keeping an eye on which other exchanges or trading platforms might become the next acquisition target, because consolidation like this tends to come in waves, not single events. Third story, and this one is pure geopolitics. A drone hit 2 ships at Egypt's Mediterranean port of Damietta. Egyptian authorities say an initial investigation found the attack caused a fire on board both vessels. The bigger concern here isn't just the incident itself, it's the context surrounding it. This is part of a wider wave of attacks on energy infrastructure spreading across the Middle East, and every single time one of these events happens, markets have to quietly price in a little more risk, even if it doesn't make the front page. Why should this be on your radar even if you've never thought about shipping routes or ports before in your life? Because the Mediterranean is one of the most important trade corridors on the entire planet, carrying a massive share of the energy and goods traffic that moves between Europe, Asia, and Africa every single day. Any instability along that route tends to show up fast, in freight rates, in shipping insurance premiums, and in overall investor risk appetite worldwide, which affects everything from oil prices to how nervous the stock market gets on any given day. This is exactly the kind of geopolitical tension that most people don't notice until it's already showing up in the price of things they buy at the store or the pump. So it's worth keeping this one on your radar, even as the headlines inevitably move on to something else next week. Fourth story, and finally, some good news for once. The Eurozone economy grew faster than economists expected in the second quarter. Growth was driven by 2 main factors: rising AI-related spending by European companies finally starting to catch up with the US, and consumer confidence coming in noticeably stronger than forecasters had modeled going into the quarter. This matters more than it might seem at first glance, because for a long time now, the dominant narrative has been that Europe was falling hopelessly behind in the tech and economic race against the US and China, dragged down by high energy costs, slow-moving regulation, and an aging population that isn't spending the way it used to. This data pushes back on that story, at least for now, and it could reopen global investor appetite for European assets, which have honestly been sitting forgotten at the bottom of a lot of portfolios over the last few years, while everyone piled into US tech instead. If you diversify internationally or you've been thinking about starting to, this might be exactly the right moment to take a second, closer look at European equities and see if there's real value the market has been quietly overlooking. Fifth and final story. The IPO market might be heating back up after a long stretch of caution and hesitation from companies waiting for the right moment. Medline, the medical supply giant, went public after raising $6.26 billion in its offering, and demand was so overwhelming that the deal ended up oversubscribed by 10 times the number of available shares. On its very first day of trading, the stock jumped more than 28%, making it one of the strongest debuts we've seen in quite a while. This matters because the IPO market is usually one of the clearest confidence gauges available to investors watching the broader economy. When a company this large decides to go public and finds that level of overwhelming demand, it signals that institutional investors are sitting on piles of cash and are genuinely willing to put fresh money into new opportunities rather than staying defensive and waiting on the sidelines. That kind of demand usually pulls more companies into the pipeline behind it, which means we could realistically be looking at a much busier IPO calendar over the coming months, opening up a whole new window of both opportunity and risk for anyone who likes getting in early on these kinds of deals. And that's it. 5 stories that actually matter this week, away from the usual noise about the Fed, oil, and AI big tech earnings. If this video helped you understand the market a little better, do me a real favor and subscribe to the channel right now, because we post multiple videos a week bringing you exactly this kind of breakdown. The news that actually moves global financial markets, explained clearly and without the fluff, so you can make better, faster decisions with your own money. Drop a like on this video if you made it this far, hit the notification bell so you don't miss the next one, and let me know down in the comments which of these 5 stories surprised you the most. See you in the next one. Stay sharp, because the market never stops moving.